Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
Hello, welcome to It's Your Smarter Money. Dr. Laura and Professor Steve are here to talk to you about the 2025 market outlook and also to review a little bit about what's happened in 2024. We hope that you've had a great start to the new year. We have great hopes for the new year. We have some concerns, and we want to talk about some of that. So I think firstly, we want to look at the overall asset class performance of 2024. We want to talk a little bit about large cap as an asset class because it's such an important asset class. It's something that everybody tends to focus on quite a bit. We want to talk a little bit about international and why it still makes sense to have some international exposure in your portfolio. Bonds for us are always the place that we hold and it's an asset class where we have stability and reliability, and we don't get too excited and upset about bond yields in terms of the returns that they produce for us. We're always looking at them as a stabilizer, but we are interested in what the bond markets are telling us. And so we want to just talk a little bit about that. And then we have some economic data that we've been paying attention to, and we thought we might just mention a little bit about that. So it's kind of packed full.
Yeah, and by the way, I just want to mention real quick: if you see high yields on a bond, always remember in the fixed income market, there's no such thing as a free lunch. If there's high yields in a particular sector of the bond market, it means there's some risk there that's probably traders have identified. So,
absolutely. So when we look at our 2024 performance, we do see that the large cap asset class has been so overwhelmingly dominant. Now, we have some other asset classes that have also performed very well. The reinsurance bonds, this is listed from best performing to worst performing.
In order.
So a lot of the other asset classes have performed. We've had a couple of asset classes that haven't performed as well. Probably the worst are the international bonds as well as natural resources and alternative lending. All of them very much asset classes that are affected by interest rates.
That's correct. And what's interesting are the reinsurance bonds were our second best performing asset class. And people may wonder what's happened since the horrible disaster in California. And right now the reinsurance bonds are only down very slightly for the year. I just checked this morning, about 0.3 or 30 basis points down, which is pretty good. But I don't think there's as much risk there to a lot of the insurance companies because a lot of insurance companies, quite honestly, cancel policies in California.
And they'll raise the premium.
That's right.
All over the country. So we, in Florida, New Jersey, Connecticut, wherever you are all going to have to pay for that. And the insurance companies always take care of themselves, right, Steve? I mean, even
they have no choice.
We saw the same thing after the hurricane, the last hurricane. We saw a little bit of a dip, but it came right back. So,
and we saw a larger dip then. It was 3 or 4% at one point. It went down pretty quickly after Hurricane Ian in Florida. But it came back pretty quickly. But we haven't seen as big a dip this time. And after that, reinsurance bonds rebounded enormously. And right now, the annualized, which we're going to show, annualized return over the last 4 years or 4.5 years is quite high. So,
yeah, I mean, Warren Buffett made a lot of his money from reinsurance, right? It's very strong asset class. So
it is.
Let's look at so when we look at just the past 5 years, we can see that large cap wasn't the best performing asset class. Actually, mid cap was, and even small cap was better than large cap.
Yeah, that's correct. And it's funny because a lot of people wouldn't realize that after what's happened in the last year or two. We all tend to think more in terms of what the most recent past. And that's a bias. I forgot the name. It's recency bias, right?
Yes,
it's called.
Yep.
And we tend to forget what's happened over longer periods of time, which is ultimately more important, especially if you're investing for retirement, or for, or you're young, starting out, don't look at what's happened in the
Right.
recent past.
And
Look
look
at
at
the
natural resources. Natural resources performed
yeah,
as well as large cap stock, which is
yep,
quite phenomenal. So, and what's
yep.
interesting is that when you see them over the 5 years, they're when one was performing, one was not, and vice versa. But over the 5 years, they both produced return. So interesting.
Even alternative lending has been a decent asset class over the last 5 years on average per year. And these are annualized rates of return, by the way, not total. So,
Right. Um, And so we know that asset allocation is working. It continues to work. It has just worked for the past, um, I don't know, since they started really measuring this back in the 70s,
hmm
asset allocation. And for people to say that it doesn't work, they don't understand it. Uh, this is a chart that JP Morgan produces where they take all the top performing asset classes, best performing on top to least performing on the bottom. And then they also compare it to an asset allocation. This past, I don't like this particular version of this chart too much because
Mm,
it only shows the past since 2010, where large cap
right.
really did perform well. If you saw the decade before, it would have told a very, very different
It was
story.
very different.
But here you see large cap, which is the green, was one of the top performing asset classes in a lot of the years. Oh, no, not the top. We have real estate, of all things, being the top, actually, what is that, 6 times out of the past uh,
Yes.
14 years or so.
Yeah.
So that actually was even the best performing asset class. And then it shows how an asset allocation strategy would work. And their asset allocation is not too unsimilar to ours. It includes large, mid, small cap. It includes commodities,
hmm
real estate, includes international. I think they have a smidgen of emerging markets in there. But it includes a whole asset allocation. It is a little bit more comparable to our models 6 and above. So it's a
Right.
little bit more
Right.
aggressive. So if you
Yeah.
see an asset allocation that's around 10, we certainly have several portions of our clients that are performing even perform much better than that. And that's
Yes.
they were in a little bit more of an aggressive portfolio. And then we have some people that didn't even achieve a 10%, and those are more conservative portfolios. So it really
That's
matters
right.
what the overall mix is.
Well, asset allocation is one of the primary determinants of your return, quite honestly. And studies have shown that.
Yes.
So this is interesting because you look where the stock market is right now. You can see that the current price to earnings ratio is about 21 and a half. That was as of the end of December. And that's a pretty rich price to earnings ratio, but we're going to delve into this a little bit more. And you're going to see that this price to earnings ratio is really, I would say, being slanted by some stocks that are overweighted in the S&P 500
But
index.
even without even looking at anything though, Steve, you can see the inflection points. For
Yes,
example, in June 2022, where the S&P was at 21.4, you
and
can
it
see
dropped.
the different heights. I mean, this is definitely considered a little bit more frothy than what um, we would expect if we were expecting stocks to continue to rise. So it does
That's correct.
give some pause in terms of what is the future going to hold for us.
That's correct. Yeah, it's a good question. And so this shows you the concentration of the S&P 500 and the price to earnings ratio of the top 10 stocks versus the rest. And so it's possible that the market really isn't overvalued because if you look at the price to earnings ratio, when you exclude those top 10 stocks, it's only 18,
Right.
which is
This really
not,
should say valuation because it's not the
yep,
concentration, it's the valuation comparison.
yes,
Yeah, the green is the top 10 stocks, which are the Magnificent Seven that everybody talks about, the Nvidia and Facebook, Meta and Google and so forth. It also includes Broadcom, Berkshire Hathaway, and JP Morgan.
Hmm.
I've heard it seems like, we had the SPANG, we had the Magnificent Seven. Now people are saying Batman as an acronym for these top 10 stocks, which includes particularly Broadcom. Um, Whatever, no matter what, I mean, this to me is really, really quite interesting because
Yeah.
yeah, you can see how out of whack um, those top 10 stocks are in comparison to the other 490 companies
Yes.
are actually at a very reasonable PE. Um, so, you know,
Yeah, and the last time we saw a huge disparity at the beginning of 2020 or so, but look at the disparity we saw in the internet craze in 98 and 99 in the year 2000. Uh,
right. And it's that doesn't necessarily mean that we're going to have a problem. I mean, if we have
no,
a problem, we might have a problem with those top 10 stocks. So they might get a little softer.
right.
Really depends whether their earnings can catch up to their price, because right now
That's correct.
the valuation is just so out of whack. But we don't
Great
necessarily
point.
think that the entire market is problematic.
Right. Yes. And so that kind of leads into why we lean toward value, of course. But,
Well, and a
so this
more
shows you the
equally
weight.
weighted, not just
Yeah.
value, but a more equally weighted.
Equally weighted is yes.
Because
Yes.
equally weighted is a different conversation actually than value. It doesn't
It
necessarily,
is. It is. Yes. And so this is unprecedented. The way the top 10 stocks in the S&P, as you can see here, going all the way back to 1996 and probably went back even further than that. We don't have the data, but I don't think you would ever see such an overweight toward 10 stocks in the S&P 500. And be honest with you, it's a violation of modern portfolio theory to have a capitalization weighted index because you really want to be better diversified. And of course, you can always look back and say, gee, do I really want to be that diversified? Maybe I would have missed out on some of the S&P 500's return. Well, I'll say, look at that again in 5 years and see how that works out.
it's a little bit of a horse race, right? So what
Yeah,
if you really, really wanted to invest in the stock, you probably should have taken all your money, your entire portfolio, and put it into NVIDIA because NVIDIA
right,
grew. I actually read that over the past at least the first 3 quarters of 2024, NVIDIA made up 20% of the return of the S&P 500. So it's been
crazy.
very much NVIDIA driving all this, but you would never just take all your money and put it all on, 13 red, you, in a Las Vegas um, type of environment. And that's what in betting like that is just really not a smart way of investing.
Well, we've been doing this for 30 years and we've seen this happen in the past. And we've seen what can go wrong with it.
Mhm.
So, yeah, it's never a great idea.
So this is the conversation of the equal weighting, not
Yeah,
necessarily value, but equal weighting, which means we have NVIDIA in here, we have Tesla in our equal weighted investments,
right,
but it's 0.2% of the index is in each stock of the top 500.
right,
It is spread out like peanut butter. No specific stock is held there's no holding that is greater in one stock versus another. And so we
right,
want equal exposure of all the top 500 stocks versus a
yep,
cap weighting, which if a stock has a greater capitalization, which is the overall number of shares outstanding times the price of their shares dictates the
yep,
cap weighting. And if people have questions about that, please ask. But it's that the price of the stock and the amount of shares outstanding that's driving the exposure of how much stock, how much, what percent that stock represents in the overall index. And so here you can
hmm
see that over since the past 20 years, they've really performed somewhat equally. There's been some separations at time, but they haven't been terribly different. But if we look at shorter windows, such as
I just want to mention at this point, if you go back to the 1950s and 'cause there were no equally weighted indices available, at least that you could invest in up until I think around 2004. Um, you would see that the equally weighted does beat capitalization weighted, and it did beat it for a substantial period of time, even since '04.
yeah, we have a
It's really
chart on
since
that,
this,
Steve, in two
yes.
charts.
And so
Get to that.
since this surge that in the S&P that's is most likely due to the overweighting in those 10 stocks, you see that capitalization weight has been ahead of equal weighting. But in the long run, we think equal weighting is a much more diversified and better approach.
So it is important to recognize that there is absolutely no question that this surge is associated with a variety of variables, but you could almost narrow it down to the AI expectation or gamble. You can narrow it down
Yes,
to the pandemic and how it just threw everything up in the air. You can also connect it to what's been happening with the excess cash that has been pushed into the market. It is somewhat of an very unnatural, unusual environment that we have been dealing with since the overall pandemic. And it has created
yes,
some anomalies that we don't think can hold.
right. I agree with that. And so the separation you can see has really occurred since January of 23. And it's so we'll see what happens, but that the separation is clear in this chart. Like what we said though, I'm not sure this is gonna hold.
Well,
Uh
because of your next chart.
yeah.
Because your next
Yeah,
chart shows really historically, and this just goes back to 1990. And yes, the
right.
S&P introduced equally weighted back in, I think it was 2003. But there
Yes.
is data. There's data that goes back, and this shows rolling 12-month returns of the differential between the S&P 500 cap
Mm-hmm.
versus the equal weighted. And so what this is showing actually is that the S&P 500 tends to underperform on average by 1.1% over the long run from the equal weighted.
Right.
And
Right.
so right now, you can see that that's not the case. This is 2022, and it remained elevated. This hasn't been updated since 2022. It's remained elevated above the red line.
Mm-hmm.
But just like anything else in statistics and what the metrics that we use in investing, things always tend to revert to the mean. They always
Yep.
tend to go back to the average. And so our expectation is that we probably will see some correction and we'll start seeing more performance from all the other stocks, which will help the equally weighted start performing better.
Or you can see those top 10 stocks start to fall back to earth and start to go back to a more, I would say, realistic valuation.
Maybe a little bit of both, right?
Yeah, a little bit of both. Yeah.
Mhm.
And you sort of the same effect back in the I would say since around 1995. And you saw that after toward the end of the internet craze, the S&P fell back to earth
Mhm.
and the equal weighted outperformed. So we could very well see that again.
So I just want to quickly say value versus growth is a kind of a different concept than equal
Yes.
versus cap weighted. And so I just want to be really, really clear what we're talking about now. Now we're talking about the whole idea of stocks that are um, a little bit more speculative. And so they're growth oriented. They're not necessarily paying out dividends. We're expecting them to have a future um, growth, but they haven't proven themselves as much versus value stocks that are more proven companies that we know products and services are already things that people want. And so there's a lot of discussion that we could have on what we think value versus growth is. I think that might be a separate video.
That'll
Um,
be a separate video. Yeah.
but
Yeah.
this is just kind of the standard breakdown that has been somewhat accepted along the way?
So I can give you a quick idea of value versus growth. A value, for example, energy stocks tend to be value stocks, and technology stocks tend to be growth stocks.
Mhm.
So we could think of it that way too.
Yeah.
Not, totally across the board, but that's a good way of thinking about it. So,
Yes. And so well, if you want to just explain to this, you can see that just looking, for example, at large cap on the left-hand side, it's showing the PE ratio right now, versus
hmm
what it has been historically over um,
last 20 years
20 years.
on
So
average.
you can see that for large cap value, it's already over what the 20-year average has been. But then when you go to the stills on the left-hand side, when you look on the growth piece, 28.9 versus 19, it's even much more so. I
Right.
actually like looking at the right-hand side of this
I
chart.
do
It's the
too.
same data, but said in a different way. It's almost like indexed against the 20-year average, and it's saying that large
hmm
value is currently trading at a P/E ratio that's 117 times what it normally is. So you can see it's over what it
117%.
normally
Yeah.
has been,
Yeah.
versus the growth, which is even
Yeah.
much more.
So it's actually 17% higher if you have to pull 100 out. It's about
Right.
17% higher.
That's
Yeah, than its average. But look at growth. Oh my God.
right. You don't see the same differential on small cap. You can see small cap,
No.
especially small cap value, um, seems to still be somewhat priced right, whereas
Yeah.
small cap growth, eh, maybe not so much.
No. So
This is
this is interesting. It shows you the valuation of value versus growth under different interest rate environments. And I think well, value apparently does better in times when interest rates are somewhat higher, and that's because I don't want to make this too technical, but when you get into the valuation of a stock, the value of a stock is the value of all of its future earnings. And so in other words, you have to do something called a net present value calculation effectively. And that net present value becomes lower when interest rates are higher. And so that affects growth stocks more than stocks like that are value stocks that are, for example, throwing off more in income in relation to their price. So they're less affected by that net present value calculation because they're throwing off more earnings in the nearer term than they are in the future.
right.
Uh,
And so if
so
I could just explain a little bit with what you're looking at,
sure.
you're looking at what they've done in this chart is they've taken data from 1979 to now and looked at different interest rate environments, not the Fed fund rate, but the 10-year Treasury rate. And
Yep.
over the recent years, a lot of you know that the 10-year Treasury rate has actually even been less than the Fed funds rate or the 1-year rate. It's been very, very low. They call
Yeah.
that an inverted yield. And so it's been very, very low. And that environment, if you look on the left-hand side of the chart, if 10-year treasuries are between 0 and 2% or 2 and 3%, which is where they've been for a long time, growth
hmm
tends to benefit more from that type of environment. However, we start moving over and looking at the last two sets of bars. If the treasury is around 4.5% or greater than 5%, which by the way, as of Friday, I think it was almost nearing 5%. I don't know what it is today. Um, uh, we start seeing that it starts changing and that value starts performing better than growth. And this is a
That's
more
right.
natural place for a 10-year bond to be as well.
Right. Yep. And this is interesting. It shows you the gap in earnings between the those seven of those 10 stocks that represent so much of the S&P in relation to the rest of the S&P, which is interesting. And so, will this continue? Well, you're starting to already see some compression here. The Mag 7, in terms of earnings growth, really outperformed the S&P in 2023 and 2024. But suddenly now, well, those are estimates, 2025 and 2026. there's an expectation that there'll be some compression. You won't see such a difference in the earnings growth of the Mag 7 versus the rest of the
And
S&P.
that's the expectation. I mean, this is Goldman Sachs forecast, but it's
Hmm.
not unlike what we're looking at in terms of other, whether it's financial institutions or other economists that are saying
Right.
these earnings are definitely out of whack. We do expect them to come more in tune with everything else.
Well, there's actually mathematical limits on how much a company's earnings can increase because if they keep increasing at such a high rate, eventually they become half the economy, and that we know that just can't, mathematically that can't work that
But
way.
we also know from having looked at the financial statements of some of these companies that some of these earnings have been amplified through some really smart financial engineering. Um, some of them may not completely reflect
Hmm.
ongoing earnings capability. It just can't be. I mean, buying back company stock and
Right.
doing all these different types of things where, selling to companies that they own or they have representation in. There's a lot of things that have been going on that have potentially exaggerated these earnings a little.
Yep.
Uh, This chart actually takes data from back to 1946 and extrapolates it and says when we've had bull markets, significant bull markets that have lasted for a couple of years, we usually see the strongest year happening in year one. Then year
Right.
two, there's a follow-up because of momentum, and there's a whole
Hmm.
around that I'm not going to get into right now. But usually by third year, it starts losing steam. And if you think about following 2022, the S&P had a strong recovery from what happened in 2022, where it was so decimated. And then in 2023 and 2024, we've seen this 1 year, 2 year growth. But history shows us that we can't necessarily anticipate the bull market to sustain itself so much going forward. I mean, this is just,
Yeah.
again, based on historical data, and you can say, well, this time is different, and maybe it is, but we tend to think that history tends to repeat itself.
And it does. Maybe not always exactly, but there is a tendency for it to look very, very similar. And this is, really a perfect reason why you need to have all these other asset classes that we do have.
I don't remember the
Um,
quote. Mark Twain said, it might not exactly repeat itself, but attempts to rhyme. Something.
yeah.
I'm sure I just did horrible things to Mark Twain. Um,
So this is really interesting. We do have international. We've always had it, but the S&P is up, or the domestic large cap stocks have so outperformed international over the last well, I guess 10, 15 years. But who knows if that's going to continue now. I think there's reasons for this. You look at the valuation for international stocks versus the S&P, they're really, really undervalued. But we were talking about it earlier, Laura and I. There are some reasons. There's a high percentage of the UK and Germany in some of these international indices, and both their economies are not really performing that well. And in part because of their energy policies, they've tried to go in those small terms into fueling their economy, their energy needs using windmills and solar. And we know that's just not going to work. And energy prices have gone up enormously. The energy prices are about triple what they are in the United States. So there's been some deindustrialization in Germany, which, has always been one of the most heavily industrialized economies. And so that's clearly affecting Germany. They've had a lot of companies moving out just due to energy costs. And England have had some of the same issues. Now, I do think that the reality is going to hit them. It's going to change, but it hasn't really as of yet.
Well,
So.
yeah, so the US has really been dominating in innovation, but it can
Hmm.
change. And it's I've heard quite a few economists talking about the fact that all central banks can really make a difference. And if their central banks in Germany and the UK start wising up, they can actually influence this a little bit further. Um, you know, international is still has a role in the idea of being diversified, both in
Yeah.
theory and also in terms of empirical long-term performance. And so
Yes.
when we look at this, we see that the international market is absolutely on sale. It is the valuation is so low um, that it may actually be a great opportunity to buy into
So
international.
I just
It,
want to go
it
back to
must sell.
something we showed earlier, which I'm not going to go back to the slide, but international small cap has been our fifth best performing asset over the last 5 years, about 10% a year. So when we show our international breakdown, ours is roughly half international small cap and the other half's international large. So our international small cap has really performed very, very well.
Yeah, so we wanted to move into just kind of having a little bit of a conversation about what's going on in interest rates because we do think that that has had an impact and will continue to have an impact of what happens in the overall economy and
Yep.
even the stock market. And so when we zoom out and we look at the federal funds rate back to before even the 60s, we can see how it has moved. At one point, it's particularly during the Reagan administration, it hit all-time highs. Um, and we saw a recession right after that. We tend to see recessions a lot of times when interest rates spike that high. I mean, it was
Yes.
close to like over 18%, which is crazy. This is the federal funds rate. This is the rate that the FOMC, that Jerome Powell and his group are actually set for the banks to trade between each other. These are the short-term rates that banks will trade in between with each other. This isn't exactly what we as consumers always see, but it does
No.
drive a lot of short-term rates. Not
Short
always
term.
long-term rates,
Right.
which we'll talk about in a minute. But we wanted to
Right.
show you this bigger picture and how, this little curve right now is at the end of this, where you see in 2024, it's starting to head south again. But if you go to the next slide, is it, oh, this, well, okay. The,
I think you're looking
that,
for
yeah,
this.
that slide, it actually shows what's happened over the past 6 months where it's been declining.
Yeah, they had a big drop in September. They lowered rates by 0.5%, and now they've had a couple of 0.25% drops since then. One in December and one, I guess, in November, it looks like. Uh,
Right. Now,
and so,
yesterday, not yesterday, last week, January 9th, it was, there was
yeah,
conversation about the fact that the Fed may not be readily dropping as much as was anticipated. The market, of course, didn't like it. Um, we still think that there's opportunity in maybe the later half of the year for there to be some additional drops. But right now, because the economy has been showing signs of strength, there may not be as many decreases as was once anticipated.
yeah, I will say the inflation report that came out, I think it was this morning, was actually pretty decent inflation report, and the S&P's right now is up about 1.5% because of that inflation
Yeah,
report. So
extremely.
we'll see. But it's not just rates that affect inflation. We're going to show you that. But I wanted to go back to this slide, right?
Yeah, this is another way of looking the yield curve. You may hear people talk about the yield curve a lot, where they'll take one particular type of investment, like a treasury. The treasury is the most basic type of yield curve, and they'll say, okay,
Right,
if it's a short-term treasury bill, or it will have a lower interest rate. If it's a longer-term treasury bill, the expectation is that the yields will be higher because you're going to be sitting there for 10 years invested in this vehicle. You would
right.
want it to be higher. And that's the normal yield curve. You may have heard over the past couple of years that people have been wringing their hands and very concerned about the fact that that hasn't been the case. The short-term yields have been actually higher than the
Higher,
long-term yields. And so
right.
this is another way of measuring it, where they actually take the 10-year yield and subtract out the short-term rates, the federal fund rates, and the expectation is that it should be in normal environments. The red line should be above this black line. But it's
Right.
not unusual. It has happened, not a lot, but back in the 1980s again, it happened where the curve inverted and short-term rates were higher than long-term rates.
Well, what's interesting is you see because you highlighted in gray are recessions, and typically that when that happens, it's been a sign that we may be headed toward a recession. You may have heard in the media saying, "Oh, the yield curve is inverted," meaning short-term rates are higher than long. That's a recession signal. But this time around, we haven't really seen a recession yet, even though it did happen again.
And you can see at the right-hand side of this chart where it's below that black line, again,
Right.
showing that it's been inverted for a while
Year
now.
or two.
Yeah,
Year or two.
2022.
Right.
But it's starting to tick up. And that's if you go to not the next slide, because we already talked
But
about
I will mention one thing. There have been times when it was inverted and it started to tick up and there was a delay. We ended up in a recession. So we're not saying we're headed that way, but it is something that's happened in the past.
yeah. Although this is what we're starting to see now in
Right.
2024, around the summertime, we started to see long-term rates starting to become a little bit more normal. And so while you don't expect, like I've heard actually, and I've read over the weekend, people talking about, oh my goodness, the yields on the short term are coming down and the yields of the long term going up. This is not normal. Well,
That
that's
is normal.
what's not normal is how it's been over the past
Right.
couple of years. It's
Right.
now almost looking like it's starting to correct itself, and it might even be signs of the economy kind of cleaning up. But you know,
Well, I
this,
think what's a takeaway from this chart here is also to show that the Federal Reserve started lowering the federal funds rate in September. And that's exactly right around the time when the 10-year Treasury started to go up. Now, that shows you that the Federal Reserve only really has much control over short-term rates. They don't have a lot of control over long-term rates. Long-term rates are affected more by traders' views on future inflation and future rates. And right now, they seem to think that I don't know what they're factoring in here, but they think rates should be higher than they had been, and that's a big increase 10-year from somewhat below 3.65 to 4.7. That is a big increase in 10-year Treasury rate.
it
So
absolutely somewhere around
who knows what that's a
4.7.
sign of, but I will say that affects a lot of aspects of the economy, which we're going to show in a minute. It really affects borrowing costs.
So the federal funds rate right now is somewhere around 4.3. The 10-year is somewhere around about 4.7. So we're
Right.
starting to get more of that correction.
Yeah. And so we're just going to jump to inflation. When you talk about inflation, there's a couple of key factors that really affect this. And this has been indicated through many studies. In particular, Milton Friedman, he wrote a book in 1960 with a woman called Anna Schwartz, and I think they both won Nobel Prizes. At the very least, he did for the book. It's called The Monetary History of the United States, and they took data going all the way back from the Civil War, and a lot of the data they had to accumulate from many, many different sources because they didn't have computers, they didn't have the federal government didn't report data like they did beginning, I guess, after probably the 1950s, I think, or maybe the 1940s. And he showed it was a high correlation between growth in the money supply and inflation. And we see this right here. We see that huge spike in the money supply, uh, which is in purple. And you see that inflation spiked right after that spike in the money supply. And so I saw somebody describe perfectly how it works. So suppose you have 10 apples and you have one apple and you have $10. And suddenly now you have more money because there's more money in the economy, but there's still only one apple, right? And now there's $15 in relation to that apple. Suddenly that apple is going to cost $15. It's just not going to cost $10 any longer, you know. And so the money supply is a major determinant of the inflation rate. And the Federal Reserve has some control over it with short-term rates, but its real control over the inflation rate is really with the money supply and how much it grows or shrinks.
Mm.
The other key input is in energy, and that there's a high correlation between inflation and energy costs. And I actually ran the correlation. Right now it's about zero point 0.7, which is a pretty high correlation. And there's a reason for this. Now, in this chart, we show you the Brent crude spot oil price, and that's the one in blue, dark blue, not actually not the purplish number. That's the U.S. Core Consumer Price Index. But you see right now, oil's around $77 a barrel. But you can see this huge spike in energy prices right around 2022, and you see right around the same time inflation spiked. And so you can take different uh, in the production process of different precursors. So supposing you're making some kind of product based on corn. Well, the main cost to the product to create it is corn. But the problem with energy is it's a cost in almost every aspect of the production of any product. And even if it's not a precursor in the actual production process, like natural gas is, by the way, a lot of people don't realize natural gas is a precursor to the production for fertilizer and also plastics. Crude oil is a precursor in the production for plastics. Energy also goes into other products for which it's not a precursor because guess what? You got to use energy to bring it to market. If it's a piece of metal and you're stamping a piece of metal, well, you need to have heavy equipment that uses a lot of energy to stamp that piece of metal. Energy is one of the primary majoring factors that drive inflation because it's an input into every piece of the economy, every bit. So
Particularly housing,
yeah, that's a really good point,
which is
including
the next
housing,
one.
your heating
Yeah.
costs. I was just thinking that, and your electricity
And
costs. So
and even building a house.
yeah, building a house. It's a great point. Yep. And so energy prices are very, very, very important to the economy. And it's still really, let's face it, 80 to 85% of our economy still is based on fossil fuels, no matter what people say. Only about 11, if you look at, there's a great website you can go to. It's the Energy Information Association. It's actually a division of the federal government, and you can see what percentage of the economy is based on various sources of energy. And even now, renewables are only about 11 or 12%, and it's actually dropped over the last year. I looked yesterday. Um, and the problem with renewables is that you can't create more energy on demand from a renewable, solar or wind, whereas with fossil fuels you can. So, and so talking about housing affordability, and this is really an important aspect of the economy because if people can, if you look at houses and when people buy houses and how much of consumer demand is based on housing, because not just buying the house, but also material you need to build a house, hiring a contractor to repair the home, all these factors that are factored into housing. Affordability is being affected by mortgage rates in part, and we're going to see that. But additionally, we've seen housing prices appreciate a lot over the last 3, 4, 5 years,
Yeah,
in
housing
part
is
because,
definitely one of the key drivers of inflation to begin with. It's
yes,
definitely
yep,
become a larger portion of the GDP and
yep. It is. And this is not a good sign for those that have recently entered the workforce and, who want to buy a home in 5 or 8 years. You graduate from college or you just graduate from high school and you have a trade job and, you're looking forward to buying your own home. Well, guess what? You may be living in mom's basement for a few more years at this rate. It's sad. It's sad. You know, I did see this, by the way, when I first left, graduate from college in the late 70s. We saw this very similar thing. So, and this shows you what we were talking about mortgage rates. Now they're pretty high in relation to the recent past right now, and they've been tracking back upward again. I think in part because of the 10-year Treasury. Mortgage rates are very highly correlated to the 10-year Treasury rate, typically.
and that's why they're probably not going to be coming down for so much. There's this anticipation that housing rates are going to come down based upon Fed cuts, and we've already
Right.
demonstrated that the 10-year yield is not coming down because of Fed cuts. So for
No,
those people that are sitting on the sidelines waiting for that piece to drop, that may not actually happen.
no.
We what would like to see possibly is maybe some of the prices at least kind of stabilize.
Yeah, hopefully.
And this just talks about another piece of what we tend to look at quite a bit is what about the labor market? And we're very concerned about when we look at unemployment. Unemployment has been falling, so that's good. On Friday, it fell again. Employers are adding jobs. We continue to look at, it's called the JOLTS report, which is really
Mm.
important because it shows the jobs that are available. If there's less jobs available, it's a tighter market. And so we see fewer openings, but it seems to be stabilizing now above 8 million, which is actually good. We've seen signs of stabilization, and that's what we want to see. So we
Yes.
see when we look at the jobs overall, we've seen really what happened in 2022 is the generation over the age of 55 left the market and they're not coming back. We are starting to see the real people that are in their earning years, the ones up to age, I think somewhere between 30 and 54, they are
Hmm.
coming back. And what's really interesting is we're seeing women drive that especially. And I
Yes.
don't know the reasons for that. I have a feeling some of it has to do with the fact that women are now able to get these jobs where they can work remotely. And so childcare or being just a caretaker in general is not
Yeah.
obstructing that. So that might
Well,
have something to do with it.
I think there's another reason on top of that. I think there's a higher percentage of, if you look at the breakdown of gender versus college graduation, a higher percentage are women.
Yeah,
I think
absolutely.
that's part of it, which is very interesting.
Right. And then, of course, we can't end this conversation without talking about the change in administration and what people are anticipating. And we went and we pulled out this actual website here is quite interesting because you can click on any one of these presidents. You can see that they're all grayed out except for Biden, Trump, and Reagan, just because if we had them all up here, it would just be so much noise you couldn't read it.
Be busy. Yeah.
But and you can see that the longer dotted line is there because Reagan had a 2-year term,
Two terms.
two
Yeah.
terms, where we've only seen
Yep.
Donald Trump and Biden have one term. But what it's important to understand that regardless of what you think about Trump and his policies and the things that he's proposing to do or whatever, even when Reagan had his victory back in 1980, he was celebrated
Hmm.
by Wall Street as being seen as transformative. And everybody was very excited about him. But for the first 2 years of his presidency, it was really quite unpleasant for many
Yep.
investors. So,
Yep.
it, regardless of what we're projecting, we don't know what's going to happen. We do know that
No.
the that usually in the first year of any presidential election, and we did not see this in Trump's first presidential election, so things can be different. We tend to see some volatility in
Yeah.
that first year as people get a handle on the new policies and so forth. So we do anticipate that there will be some additional volatility over the next year.
Most likely. Yep.
Mhm. And so this Steve and I were talking about this gentleman. He actually was a trader back in he was born in the 1800s, so this is
Hmm.
back in like the earlier part of the last century. And he was quoted as saying this, and it's really quite an important observation that whenever you think that, oh, you really, really understand the stock market and you know where it's going, you really should take a big swallow of humility and just realize that it's very, very difficult to be able to predict. Here are the things we know. We know that part of the stock market is very expensive, not all of it. We know
Yeah.
that the remaining 490 are not as expensive, and the value stocks might not be in such a precarious situation. We
Right.
know that there's less probability of a recession based upon the things that we're seeing, the economic data, and
Hmm.
that we probably possibly may not see a recession, but we do see an overall jittery market, and that alone, just it being a jittery market, could potentially influence Powell to reduce Fed rates. But we again, we really don't know how
And will it
things
make much
will.
of a difference? We don't know. Even if he
Um,
does.
So,
Yeah.
again, the asset allocation, the diversified strategy into an
Yep.
all-weather strategy where we'll always have asset classes that perform. And if you recall back in 2022, for those of you that were with us, we had four asset classes that performed while the
Yep.
US market and the bond market were both down by around 20%. So
That's
um,
correct.
it's important to understand why you're in this very diversified portfolio.
By the way, based on this fellow's name and the fact I never heard of him and his statement, I thought you made this up for the presentation.
Have a great 2025. We are always here. We're reaching out to people we haven't spoken to maybe before the end of 2024, especially if you haven't had a year review with or a recent quarterly review with us.
Yes.
We would love to meet with you to talk about what's going on in your life and what's going on in your portfolio. Are you a more aggressive portfolio? Are you a less aggressive portfolio? How are you feeling about that? So please feel free to reach out to us.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.